Gen Z's average credit score just dropped 12 points in a single quarter. Despite being the most financially content-consuming generation in history, you're watching more money content, reading more threads, following more finance creators than any generation before you, and the scores are still going down. The problem isn't information. It's that nobody is telling you the specific dollar cost of each mistake you're making right now. So that's what this is. Not a list of tips, a damage report. Every single mistake on this list has a real dollar figure attached to it. And by the time we get to mistake number 8, you're going to realize the credit system is designed to catch people who think they're doing everything right. Here's the thing most people warn you about: missing a payment. That's only number 1. The other 9 are quietly doing more damage to your financial future than a single missed payment ever could. And most of them, you probably started doing last week without realizing it. Let's get into it. Mistake number 1. Paying only the minimum. 58% of Gen Z does this. More than half. And it feels responsible. You're paying something, you're not ignoring the bill. The app shows a green check mark. But here's what's actually happening. You have $3,000 on a card at 22% APR, which is right around the national average right now. If you pay only the minimum every single month, you will spend the next 19 years paying that balance off, and you will hand the credit card company over $4,500 in pure interest on top of the original $3,000. You borrowed $3,000. You paid back over $7,500. The minimum payment is not a goal. It's a trapdoor. The bank designed it to look exactly like the responsible option. Mistake number 2. Missing a payment, even by one day. Most people know about this one, but they consistently underestimate the actual hit. One missed payment can drop your credit score anywhere from 17 to 83 points depending on where your score sits right now. If you're in the 680, 720 range and you miss one payment, you could wake up the next month 60 points lower. That's not a bad month. That's a different financial profile. Lenders see you differently. Insurers see you differently. Landlords see you differently. And beyond the score, the late fee average is $32. Annoying but manageable, right? Now multiply that by every 20-something doing the same thing. Americans paid $14.5 billion in credit card late fees in 2022. That's not a consumer problem. That's a system working exactly the way it was built to work, just not for you. Set up auto-pay for the minimum, not because you plan to pay only the minimum, but because it guarantees you never miss a due date while you figure out the rest. Mistake number 3. Maxing out the card. 15.3% of Gen Z is already maxed out. And even if you're not fully maxed, crossing 30% utilization, meaning you've used 30% of your available credit limit, triggers a 15 to 35-point score drop. Every time. That's not a penalty for being irresponsible. That's the model treating high utilization as a risk signal, regardless of whether you plan to pay it back in full next week. Go above 50% utilization, and you're looking at a 50 to 100 plus point drop depending on your history. So you put $1,500 on a $2,000 limit card for a laptop you were going to pay off next month, and your score tanks before you even get the bill. The scoring algorithm doesn't know your plan. It just sees the number. Keep utilization under 10% if you want to see your score actually climb. Under 30% is the floor, not the target. Here's one almost nobody talks about seriously. Mistake number 4. Not knowing your APR. 33% of Gen Z does not know the interest rate on their credit card. 1 in 3 people carrying a balance have no idea what that balance is costing them per year. The national average right now sits between 21% and 23%. The average Gen Z cardholder is carrying $3,493 in credit card debt. At 22% APR, that balance runs $768 a year in pure interest, just to stand still. Not to pay it down. Not to get ahead. $768 a year to hold the debt at its current size. That's $64 a month. Gone. For nothing. Just because they didn't open the app and check the interest rate section. Go find yours right now. It's in the app, in the cardholder agreement, or in your account settings. Once you know the number, it becomes real. And once it's real, you start making different decisions. Mistake number 5. Closing old cards. A lot of people do this thinking they're being disciplined. I don't use this card. I don't need the temptation. I'll just close it. Makes sense on the surface. Here's what actually happens. Your credit score depends heavily on two things: your credit utilization ratio and your average account age. When you close an old card, both take a hit at the same time. Say you have a $25,000 limit card you never use, and your current balances total $7,500. Right now, your utilization is 30%. You close that card. Your available credit drops by $25,000, and your utilization jumps overnight from 30% to 67%. You're looking at a potential 30 to 50 point score drop from a card you weren't even using. The card being open and empty is an asset. Its limit works for you every single day just by existing. Keep it. Run it once every 6 months on something small so they don't close it for inactivity. Pay it off immediately. That's it. Mistake number 6. Opening too many cards at once. Every time you apply for a new credit card, the issuer runs a hard inquiry on your credit report. Each one drops your score 3 to 5 points. That sounds small, but stacking multiple applications within a 12-month window sends a specific signal to every lender who pulls your report. That signal reads as financial desperation, not ambition, not smart credit building. Desperation. Lenders see someone applying for multiple lines of credit in a short window, and they read it as, "This person needs money they don't have." And once that signal sits in your file, your approval odds drop and your offered interest rates go up. Across the board, not just on one card. 1 card a year if you're building credit from zero. 2 maximum if your score is already above 700 and you're doing it strategically. More than that and you're working against yourself. Now we're getting into the ones quietly wrecking people who think they're being smart. Mistake number 7. Taking cash advances. You need $500 in cash. Your card has $2,000 available. The ATM is right there. Seems fine. Here's what's actually happening. Cash advances carry a separate higher APR, averaging 24.7%. There is no grace period. Interest starts accruing the moment you pull the money out. And there's typically a fee of either $10 or 3% to 5% of the amount, whichever is higher. Take $500 as a cash advance. By the time you factor in the fee and the immediate interest accrual, you're looking at $538.95 before you've made a single payment. Pay that off with minimum payments? 67 months. Over 5.5 years. On a $500 cash grab. Cash advances are the highest cost product on your credit card. The bank makes more money from one cash advance than from months of regular purchases. That's not a coincidence. Mistake number 8. Paying your current balance instead of your statement balance. First-time cardholders who are doing everything right get caught by this one constantly. You download a budgeting app, you check your card balance in real time, you see $347 sitting there. You pay $347. Done. You're in the clear. Except you're not. The statement balance is the amount on your last official billing statement, the snapshot the bank took on your closing date. The current balance includes everything since then. When you pay only the current balance showing in real time, you may be leaving your statement balance unpaid. And the moment you don't pay your full statement balance, the bank starts charging interest on your entire previous billing cycle, retroactively. Not just on the remaining amount, on everything that passed through that cycle. Millions of first-time cardholders get hit with interest charges on months they thought were fully paid off. Always pay the statement balance. Find it in your billing statements section, not the home screen of your app. Mistake number 9. Opening a store card for the discount. You're at the register. The cashier says you can save 20% today if you open a store card. On a $500 purchase, that's $100 off. You do the math and it feels like a win. What they don't tell you at the register is that store and retail cards carry some of the highest APRs in the entire credit card market, averaging 28% to 30% and sometimes higher. You saved $100 at checkout. You now have a $400 balance on a card charging 29% APR. You pay the minimum. You just turned a $400 balance into $700 plus by the time it's cleared. You're down $300 on what felt like a smart savings move. And here's the secondary damage. That new account dropped your average account age. That hard inquiry dinged your score. And if you forget to use the card every 6 months, they close it. which hits your utilization ratio again. The 20% discount is bait. The 29% APR is the hook. Mistake number 10. Relying on your credit card as an emergency fund. 43% of Gen Z says they don't need an emergency fund because they have credit cards. Nearly half. And I get it. The logic makes sense on the surface. The credit is there. It's available. Why park $1,000 in a savings account earning 4% when you can leave it invested and use the card if something comes up? Here's what happens when you actually use it. $1,000 emergency. Card at 22% APR. You pay the minimum. That balance doesn't clear for years, and by the time it does, you've paid $400 to $600 in interest on top of the original emergency. A $1,000 car repair just cost you $1,500. A $1,000 medical bill just cost you $1,600. And now you're carrying debt that follows you into every next financial decision. The credit card is not an emergency fund. It's a bridge loan at 22% interest with no fixed payoff date. An actual emergency fund, even $500 sitting in a high-yield savings account, costs you nothing to use and leaves your credit score untouched. Now here's the math moment. The one number that puts all of this into context. You're 22. You make every mistake on this list for the next 2 to 3 years. Your score settles somewhere around 620. Now watch what that costs you over the next decade. At 22, you finance a $30,000 car. With a 760 credit score, you get an interest rate around 5%. Monthly payment, $566. Total interest paid, $3,968. With a 620 score, your rate jumps to somewhere around 11% to 12%. Monthly payment, $650. Total interest paid over the loan, $13,500 difference. Same car, same loan amount, different credit score. Then you go to rent an apartment. Landlords in major cities routinely charge double or triple the standard security deposit for applicants with low scores. That's an extra $2,000 to $4,000 sitting out of your account for the duration of your lease. Then there's renter's insurance. Poor credit makes your renter's insurance premium 66% more expensive on average. Same coverage. Same apartment. Just a different credit tier. Stack the car loan penalty, the security deposits, the insurance premiums, and the interest you're paying on carried credit card balances, and the total 10-year cost of bad credit at age 22 runs into the tens of thousands of dollars. Not hypothetically, provably, specifically, mathematically. Your credit score isn't just a number. It's a tax you pay on every major financial transaction in your life. And unlike income tax, nobody files it for you or explains the bill. So here's the 3-rule system that fixes most of this. Rule 1. Pay your full statement balance every single month. Not the minimum. Not the current balance showing in the app. The statement balance. Every single month. Not the minimum. Not the current balance showing in the app. The statement balance. Rule 2. Keep your utilization below 10%. Not 30%. 10. If your limit is $2,000, try not to carry more than $200 on the card at any given time. Pay it down mid-cycle if you need to. Your score refreshes every 30 days. Give it clean numbers to work with. Rule 3. Build a cash emergency fund before you think you need one. Even $500 in a high-yield savings account changes how you use your credit card. You stop treating it like a lifeline and start treating it like a tool. 3 rules. No apps you have to buy. No credit repair service you have to pay. Just decisions you make this week. Here's what most people won't say out loud. The credit card companies are not rooting for you to figure this out. Every mistake on this list generates revenue for the issuer. The minimum payment trap alone pulls billions of dollars a year out of people who are genuinely trying to do the right thing. You are not behind because you don't work hard enough or earn enough. You're behind because you were handed a financial product with no instruction manual and told to figure it out. So drop your number in the comments, not your score, just where you landed. Did you recognize yourself in 2 of these? 6? All 10? I want to know which mistake hit hardest for you, because that's the one worth talking about. If this gave you something to think about, hit the like button and pass it to someone in their 20s who needs to hear it. and subscribe if you want to be here next week, because we're getting into exactly how to go from a 580 to a 720 in under 12 months, and the steps are not what the credit repair industry wants you to know.